Okay, taking a look at this week, we have got a busy week with the Bank of Japan meeting, the Federal Reserve, Bank of England meeting, as well as some significant data points. So we have a slow start to the week. Monday is not particularly strong. We've got a absence of major drivers in the morning session, and then we got some German inflation data out, not likely to move markets. One thing to look out for sort of early evening time UK is Bank of Canada Governor Macklem's speech. He has been giving some more dovish comments. And what he said last week is that the Bank of Canada may not have to raise interest rates further. And that just allowed the Canadian dollar to weaken a little bit into the end of last week, alongside some of the pullback in oil, which was just giving the CAD a little bit of a sell bias. So just watch out for Bank of Canada's Governor Macklem, whether he sort of reinforces that idea of peak interest rates for the Bank of Canada. It's worth looking for. You can see short-term interest rate markets at the moment are sort of saying that that's just about right for rates. The Bank of Canada are probably at peak interest rates according to Stir Markets. And you can see they're expected to hold interest rates on their 6th of December meeting. So just watch out for that. It's unlikely to be any major moves, but it may impact pricing. And obviously, it could see a little spike in the Canadian dollar if Bank of Canada's government move more in line with the previous guidance that the Bank of Canada is prepared to raise interest rates if necessary. You just want to push back against that narrative a little bit last week. The RBA, just remember the big picture, what's going on there. You can see that we have had an interest rate expectation shift from the Reserve Bank of Australia. And you can see they're now expected to hike interest rates by 25 basis points for their November the 7th meeting. And you can just see that little uptick in expectations for interest rates. You can see how it's impacted the Stir market curve as well. Now, that has been driven by this high inflationary data we've had out of Australia. It's one of the concerns that the Reserve Bank of Australia had, that inflation was going to be, more sticky than they'd anticipated. And whether this is a material revision to inflation expectations remains to be seen. RBA's Bullock, she was a little bit kind of indifferent about that CPI print when she spoke after it. She wasn't sort of saying, oh, that's a definite interest rate hike from the RBA. But then we had the PPI data at the end of the week, and again, that was high. So, with a bit more optimism over China and higher inflation pressures out of Australia, we have been seeing the Australian dollar seeing some bids. So, just keep your eye on that. If we see any sort of further hints of a 25 basis point rate hike, may see some Aussie upside from RBA Jones's speech, but more likely to be from Bullock if she speaks. But it's just a force in the background worth being aware of. Now, China data, this remains interesting. Expectations are that China's third quarter, fourth quarter should start to pick up in activity. So, if we see this moving higher in line with the greater stimulatory promises we've been having, there seems to be a day doesn't seem to go past without further assurances of stimulus and support for China's either banks, struggling property sector, and all of that just means that we are seeing dips in Chinese equity markets that are being bought. And what's good for China is also good for the Australian dollar. So if this comes in higher than markets are expecting, watch out for Australian dollar strength. The Bank of Japan interest rate decision. There are no changes expected for the Bank of Japan interest rate decision. And last week, the report was that the Bank of Japan doesn't see any need to change their forward guidance, that they are considering whether to tweak the yield curve control, and that will depend on the path of US rates. So, in other words, Bank of Japan's looking at this move higher in yields, okay? And if this move higher in yields keeps pushing higher and higher and higher, it's going to be greater concern to the Bank of Japan. Now, they're wanting to keep optionality on the table. If they do announce a tweak to their yield curve control policy, look out for yen strength. If they do exit negative interest rates, look out for yen strength. No change is expected, okay? And there's no expectations for an immediate change to the yield curve control, and there's no expectations that interest rates will rise. But if they do happen, expect sudden yen strength. We've been seeing significant yen weakness over, a significant period of time. Weakness, 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 and markets keep speculating: when's the Bank of Japan going to exit their yield curve control? When are they going to start hiking interest rates? And if and when they do that, then we can expect the yen, this is the yen at index level, to start gaining. And that would be, particularly look out for some crosses that have a lot of, dollar yen cross, for instance, would see significant downside on that kind of announcement. So just keep your eye on the Bank of Japan interest rate decision, and watch out for that. The sort of decisions sort of a rolling start from about 3 a.m. UK time. We've got Eurozone inflation data out here. Now, last week we had the ECB rate meeting, and essentially, without saying this is the peak in interest rates, they really pretty much indicated that, with growth concerns in the Eurozone and, the impact of previous interest rates still to be felt in the European economy, there were expectations that the ECB's hikes so far will still be felt in the first quarter of 2024, and it may even be beyond that, that the impact of previous interest rates are still being felt in the economy. So what we're looking for here is, if this comes in below market's minimum expectations, could expect a little bit more euro downside, because it will just reaffirm the narrative that the ECB have reached peak interest rates. So look for euro weakness. This comes in below market's minimum expectations. So the year on year below 2.8, core below 4.1. Look out for euro weakness. Now, also, if we see a high reading, we could also expect a little bit of a pushback from the recent narrative that the ECB won't have to hike interest rates any further. So if this comes in 4.4 core and above 3.7 for the headline, and then the other metrics are sort of in line with expectations, and look for a little bit of upside in the euro. And could potentially look at maybe a little bit of upside in maybe the euro pound, or otherwise just look for a weak currency on the day. Now, moving through to the afternoon, on Tuesday, we've got US consumer confidence. Again, if this comes in very low, below market's minimum expectations, we've seen a lot of dollar strength. You can see the dollar aggregate, dollar index from a CFTC positioning point of view stretched to the upside. So anything that's a reason to sell the dollar, you can expect weakness in the US dollar. So if we have a weak consumer confidence data point, look for weakness in the dollar. New Zealand employment labor data coming out, again, weak employment data will be seen as deflationary, New Zealand dollar negative, so Aussie New Zealand dollar upside. Strong employment data will be seen as inflationary, and will be New Zealand dollar positive. Potentially look for some Aussie New Zealand dollar downside. Okay, so if this is a big miss, then you can look for Aussie New Zealand dollar upside if the participation rate comes in as expected or below. Unemployment rate, if that comes in 3.9% or higher. If the employment change comes in, 0.5% or higher, and we see a miss in the data, so it's worse than markets are expecting, and this is red, then we would expect to see New Zealand dollar weakness, and that'd be Aussie New Zealand dollar upside. And that would be the best kind of opportunity, would be Aussie New Zealand dollar upside, because there has been growing expectations for a more hawkish RBA. And so ideally, we'd like to see the Aussie gain against the New Zealand dollar in an ideal world. More Chinese PMI data on the Wednesday. Again, the same playbook as was earlier before. SMB's Jordan speech. Look out for this. Remember the problem with the SMB is that they have an incentive to keep the Swiss franc strong, because when the Swiss franc is strong, it means that the strong Swiss franc helps their imports remain cheap. And if imports are cheap, it keeps domestic inflation lower, right? So this strong Swiss franc has been quite helpful for the Swiss. So they want to kind of stress, we've got problems with we've got inflation problems. If you look at Swiss core inflation, they haven't really got a problem with it. It's 1.3%, and the headline is 1.7%. And if you compare that to other G20 countries, look, it's some of the lowest inflation in the G20, second lowest. So that means that the interest rate level shouldn't need to rise for the SMB. That 100% expectation as a whole, and it should only sort of lower from here. And you can see expectations are now for a 25 basis point rate cut in June. So what does SMB Jordan say about that? Does he start to the reach points where if he sort of stresses inflation problems and risks, at some point the market won't sort of believe him, and you can see the Swiss franc is selling off now. Obviously, Swiss franc gains on geopolitical risk. Okay, so as geopolitical risk is in the background, if that elevates, look for Swiss franc buying. If it de-escalates, look for Swiss franc selling. Markets this morning are sort of saying, okay, Netanyahu, Israel's PM, is proceeding a little bit more cautiously, conservatively in Gaza. So that's why we're seeing oil pull off its highs. That's why we're seeing gold pull off its highs. And that's also part of the reason why we're seeing the Swiss franc pull back. Just watch out for if he sort of says, right, we're at peak rate, we're in control, maybe expect a little bit of adjustment now, then look out for southern Swiss franc selling. ISM PMIs for the US. This is the most important ISM PMI print, and so it will be closely followed. If we see a big miss in the data, big miss constitutes 48 or lower, then look for dollar weakness. Okay, you potentially could see some S&P 500 upside, but just what you have to be aware of is where geopolitical risk is, because geopolitical risk can result in equity market selling. But just on the US data, you'd still expect a miss here to be supportive for stocks and weaken the dollar. You'd expect that to send yields lower, dollar yen lower. You also have to keep in mind the jobs data that's going on at the same time. Fed interest rate decision. Now, expectations for the interest rate decision for the Federal Reserve remain pretty solid. 99% chance that they're going to be completely on hold. That no one's really expecting a hike, and short-term interest rate markets are sort of saying this is peak interest rates, and the consensus is that this is probably peak interest rates for the Fed. So no one's expecting the Fed to do anything but keep rates unchanged. But what's going to be interesting here is where do they see the future going? How are they talking about interest rate cuts? The present expectations of short-term interest rate markets is that there will be an interest rate cut next year, but it'll sort of come in around June or July. So current pricing is for an interest rate cut in July of next year. So what do the Fed see about the path of US growth? What do they see about the robust nature of US GDP? Do they see that continuing, or do they see that slowing down? What's the path that the Fed see for the US economy moving forward? So it's going to be a situation where the forward guidance is going to be determining this situation. If we see a more dovish outlook from the Fed, then look for upside in S&P 500. Look for downside in dollar, downside in dollar yen. If anything's more hawkish, if they either hike by 25 basis points or they see the need for further interest rate hikes, you expect immediate upside in dollar. But remember, dollar's very stretched to the upside. So we're very cautious about chasing further dollar longs. We want to see reasons for dollar weakness. We want to see reasons for some of this dollar strength to unwind. And this aggregate position here, of course, in the CFTC report is not just the dollar index, but anywhere where the dollar constitutes a component of the instrument. So, yeah, important. Swiss inflation, this could be important. If we see a big miss here, sub 1.6 for the headline, and if we see this moving lower below market expectation, look for southern Swiss franc selling. Keep geopolitical risk in mind. Swiss franc can see bids on geopolitical risk. 70% of all gold is refined through Switzerland. So good news for gold also lifts the Swiss franc. So just keep that in mind. But just purely on the Swiss picture, low inflation should keep the Swiss franc pressure to the downside. And one currency to really keep your eye on over the next few months is the Swiss franc Japanese yen. Look at the bond yield spread between Swiss's 10-year bond and Japan's 10-year bond yield. You can see they're moving sharply lower. So it's not unreasonable to expect this price to move down in line with the yield spread, as long as the current dynamics keep playing out. Low inflation. There's no reason why the Swiss should need to be aggressive in their interest rate hikes. But there is a reason for the Bank of Japan to start exiting their yield curve control policy. They are saying they will do it eventually. They are expecting to leave their negative interest rates at some point. So you would expect Swiss franc yen to move lower. You expect the yen to find strength, Swiss to start pulling back from some of its, you know, overvalued position here, right? And you can see it's pulling back from that level. And you got some, pretty major kind of support coming up here. But if that breaks lower, then you expect that to continue to the downside. So that is going to be a very interesting print. And the big miss there, look for Swiss franc yen selling, depending what the Bank of Japan do. Otherwise, look for Swiss franc selling would be the best opportunity. Even selling it, into the meeting is not unreasonable. Now, the Bank of England are meeting, and the situation with the Bank of England remains that the Bank of England is expecting a marked fall in inflation. They're expected to hold interest rates unchanged. And they're expecting the average weekly earnings data to start falling lower. So they're expecting the outlook for the UK to start sort of worsening, inflation to start falling. And the expectations here is, when do the Bank of England start to see interest rate cuts coming? Now, at the moment, for this meeting, no change is expected for rates. And for next year, markets are expecting first interest rate cut around August, September of next year. So we've seen the pound from an aggregate position. It had, 6-8 weeks ago, the pound was stretched to the long side. It's been moving lower and lower and lower. So the pound is moving lower on as long as a lot of those longs are stretched. So from an index level, you could see the pound push back a little bit of a retracement. If you look at the pound on the index level, you'll see it more clearly. Just look at the pound here. Where are we? There we go. You can see pound's trying to find a little bit of a bottom there. Yes, you can see since the summer, pound had been sold off, sold off, sold off. Now it's trying to find a bottom. So I think what we need to look for in the interest rate decision is some kind of clear indication where the Bank of England see things going. If they start to see, worsening UK economy, they're stressing revisions lower in growth, revisions lower in inflation, then look for pound selling. If they revise growth lower and inflation higher, again, look for pound selling because it'll be a stagflationary perspective. But the best opportunity is still likely to be selling the pound. Okay, that's still the best opportunity that I would favour, and I would be looking for the Bank of England to be recognising that slowing growth outlook. Okay, into Friday, more Chinese data, same outlook there. Strong data should support the Australian dollar. Weak reading should weaken the Australian dollar. The Canadian jobs data is going to be important, and the US. And remember, the way to understand employment data at the moment is through an inflationary or deflationary lens. Strong employment is inflationary and will be currency positive. Weak employment data is deflationary and will be currency negative. So, right, you've got non-farm payroll is probably the most important for the US. If this is a big miss in the data, then look for dollar downside, dollar yen downside. That would be the best opportunity. You compare it with a stronger currency on the day. But for a weak reading, we want to see average hourly earnings coming in, sub 3.9. We want to see the headline coming in sub 98,000. Average weekly hours, we want to see that coming in sub 34.4. Participation rate as is or lower. Unemployment rate 3.9% or higher. Okay. The non-farm payrolls headline, below 14,000, not below 98. That was the private data. We want to see the headline below 140, and all of that should be dollar negative. So you expect something like dollar yen downside, so it also push yields lower. So you'd expect dollar yen selling, euro US dollar buying. Okay. Now Canadian data is at the same time. So if we had very strong Canadian data, it pushes the pressure back onto Macklem that the Bank of Canada may need to have one more rate hike. So you can see dollar CAD downside if the US non-farm payroll data is very weak. Otherwise, the best opportunity from a big miss. Big miss, look for CAD weakness. Okay, and CAD weakness, you just look to pair the CAD with a stronger currency. Best opportunity would be on a miss in the data. Okay, ISM services data out later as well. Got the PMI coming out at 2 o'clock UK time. So watch out for the interplay between the payroll and the services data, and then finishing off with Bank of England's Haskell and Fed Barr's speech. So that's what we're looking for this week. It's quite an action-packed week. Um, the key sort of narratives to be aware of in terms of positioning, it's got stretched dollar longs and we got stretched Aussie dollar short. So reasons to buy the Aussie dollar should be embraced. As long as that remains the case, reasons to sell the US dollar look attractive. Through all of this, you've got to remember the geopolitical risk. And when geopolitical risk is elevated, we're seeing you tend to see gold being bought or oil being sold, and you tend to see moves into the safe havens, Swiss franc, yen, and sometimes the dollar. The currency moves have been choppy. Sometimes you've been seeing dollar bid, sometimes you haven't. Sometimes you're seeing the yen bid, sometimes you haven't. Sometimes the Swiss franc has been bid, sometimes it hasn't. So in the current geopolitical risk climate, it's been gold and oil that have been more consistent players, but you can't just ignore the normal risk on, risk off moves. So bear that in mind that whatever's going on with the economic data, you also have to think to yourself, where are we in the geopolitical crisis? At the moment, markets are more assured. Israel's PM Netanyahu is taking what's reported to be a more conservative approach at the time of making this video. Look, it could change on a dime. We all know that. But at the moment, they're not wanting to press on, regardless of international opinion. They're trying to press on with the move into Gaza in a sort of more conservative way is being reported. That's why we didn't see gold sort of making fresh new highs on the open this morning. Okay, folks, that's the major things to keep an eye on as we head into a pretty busy week.